Hi, welcome back. Today we're going to talk about chapter 10, which is stockholder equity. In this chapter, I decided to divide it into three parts. The first part is talk about invested capital, which is the money that the other people give to you to run the company. And then second part, we're going to talk about earned capital, which is our return earning. In our chapter one, we kind of talk about it. How do you internally funding yourself? In the last portion, we're going to talk about stock equity analysis, such as what is your earnings per share and how is your price earning ratio. So to understanding the how does the stock market think about your company's earning potential and whether this company is actually paying dividend enough to attracting future investment. So without further ado, let's look at the first uh, part of our lecture. Okay, so let me see how to do this. Share screen. Mm, okay, looks cool. Mm, so chapter 10, we majorly focused on the stockholders equity account. Basically, is actually we already covered the assets, which is the resources of the company. And the last two chapters, we talk about the current liability and long-term liability. And right now, we're using one chapter to talk about the stockholder equity. Okay. So as we know, the fundamental accounting formula is asset equals the liability plus the stockholder equity. And then we said the asset is the resources of company and liability and the stockholder equity are capital structure of the firm. How does the firm funded by different sources to accumulating its resources, right? And we say liability is basically borrowing or creditors claims, those people who actually have a fixed return and then they majorly evaluating your risks of bankruptcy, right? And the stockholder equity are actually a true owner of the company, and then they have the claim of the residual incomes. Basically, the company make money using its resources after they pay the liability fiduciary duty such as interest and the principal, and the leftovers are all claimed for the owners. And so in order to further understanding what is actually stockholder equity, we divide it into three parts. First one, the primary components of a stockholder equity are paid in capital. First one is paid in capital. So what is a paid in capital? Paid in capital means the amount of the stockholder have invested, right? Have invested in the company. Returned earning is the amount of the earning the company has kept or retained that the earning is not distributed in terms of dividend to the stockholder over the life of the company. And treasury stock is a company's own issued stock that has been repurchased. Okay, we're going to talk a lot about why treasury stock is important. Okay, so first part we want to talk about invested capital. So as we know, we wanted to identify the advantage and disadvantage of a corporate form of this ownership. As you remember in the first chapter, we say there's a lot of different form of investment. Investment one is called a sole proprietorship, right? Means that you own a company and all the risks you are taking on your own, and there's a limited partnership, and there's a corporation. And then each of this form of the ownership styles is actually have its own benefits. For example, sole proprietorship means that the company and the personal income of the owner is not separable. right? And limited partnership actually taxing the partners after the earnings through their own personal income taxes. Corporation is actually most interesting form. It's because it's a double taxed. The reason is we treat in the tax authority's eye, corporation itself can be considered as a legal identity, meaning that corporate has to pay tax and the distribution to the owner, which is the stockholders also being taxed as well at the because the dividend distributed to the owner is taxed, and at the same time, the net income of the corporation is also taxed. Hence, that this is something we call a double tax. Okay, so let's look at the organization chart of a corporation. Corporations are formed in accordance to the law of an individual state. The individual states incorporate laws guide the corporate as they write their article of incorporation, right? So before you organize a corporation, you need to write article of incorporation. And then this is governed by each state. Each state has a different way of regulating how to incorporate a corporation. And then we call that corporate charter, right? So the article of incorporate describe three things. A, nature of your business. Are you selling stuff, or are you providing services, or are you entertainment industry, or are you farmers? So you will state your nature of the business. And second, if you are trying to distribute in share, or you are a public firm, you needed to say the shares of stocks to be issued. And three, you needed to tell them that the initial board of director. Okay, so the board of directors establish corporate policy and appoint officers who are going to managing the company, right? Ultimately, the corporate stockholders control the company because stockholders electing board director, and board directors appoint which one is their CEO. And then under the CEO, they organize saying management, marketing department, or CFO, legal counseling, and human resources. In other words, stockholder, they have a voting rights to selecting board director, and board directors appoint or hire CEOs. Okay. Okay. So the stage of equity financing. So corporate usually first raise money from founder of the business, such as friends and families. And then to grow bigger, companies seek investor from several different kind of people. First of all, it can called angel investor. Angel investors are usually the wealthy investors, like featured on the television of like Shark Tank. Those people have a lot of money and they were looking for investment, high risk investment opportunities that they themselves believe it's gonna be a prosperity. And then second thing is you can invite venture capitals. Usually venture capital firms only invest in firms that they know that it's gonna work out, and they were providing additional funding. At the same time, they will give you more profound business advices or distribution channel or marketing advices. And then if the capital, which is equity, is bigger than 20 million usually, and then you can consider whether you wanted to publicly trading your company's shares or equity ownership. So we call the initial public offering. That means that it's the first time a corporation issues stocks to the general public. So if we're using a graph to actually illustrating the stages of a company's growth, right? So the progression leading to a public offering might include in some of these steps. First of all, you got to believe in your own corporation, such as your investment by a founder of business, so usually it's yourself, and then you're persuading your friends join you and their families. So you got to figure out the idea and you believe in that idea, and then you have to water it, that idea. And then if it's growing fast, and then you can inviting other people to be investors, usually the close friends. And then once it's actually really become something that you, it has a fixed model of operation and it's become successful, then you can inviting outside investments such as angel investors or venture capital firms. And then once it's grow very well, right? And then you can start considering whether you want to conduct the initial public offering. So angel investors, I want to say, is and the venture capitalists, they are very high risk takers, and then they usually are very good at spotting good business ideas. So angel investors are wealthy individuals in the business community. And then they are willing to take risks, risk investment funding on the promising business ideas. Individual angel investors may invest from a few $1,000s to a few $1,000,000 in the corporation. And venture capitalists, capital firms are providing additional financing, often in millions, right, to for percentage of ownership in the company. And many venture capital firms look for investment in promising companies to which they can add in value through business contacts or financial expertise or marketing channel. Okay, so there's a difference between public and private corporation. First of all, public firms allow public investment, and the private firms does not need or does not collecting or gathering public investment. And then publics, of course, if you allow public investment, you will have a lot more stockholders, and a private company usually have a few stockholders. And a public firm regulated by SEC, the Stock Exchange Commission, and then the private firm is not regulated by SEC at all. Okay, and an example of a public firm is Walmart or Microsoft or Intel, and the biggest private firm in United States is Cargill, which is an agricultural commodity company, or Coke industry, which is majorly in doing oil and gas industry. Mars is actually food and candy industry. Usually, companies are usually starting very small, right? And privately held. And then as a success broaden the opportunities for expansion, corporate usually go to public. For example, Facebook was a private corporation, and until it went to public in May 2012, and it raised about the $16 billion of initial investment funding from outside. And then Alibaba is actually a Chinese online commercial company, similar like eBay. And the first time it went to initial public offering in 2014, it raised about $25 billion of outside funding. And it become the biggest outside funding in history. Okay, IPO in history. Okay, so then you ask me if I am a stockholder and what is my rights. Your rights is including, first you can vote, right? You can vote on the matters such as who you wanted to select as your corporate director, who should be on the board. And second thing is that you have a right to receive a dividend. Stockholder shares the profits when the company declares a dividend. The percentage of shares stockholder owns determine his or her share of dividend distributed. For example, if they declare $2 million of cash dividend, and then there's 2 million shares outstanding, right? And you holding say 100 shares. That means that for one outstanding share, there's going to be $1 of cash dividend, then you will receive $100 of dividend. Okay, so this means that your share is a representation of the proportion that you can get when they declare dividend, when dividend is distributed. And also your share also representing the rights to share in the distribution of asset. So what that means that the shareholders share the distribution of asset if a company is dissolved. Say if this company went to bankruptcy, after paying the debt holders, right? And preferred stockholders, whatever left, you have the right to claim the resources proportionally to the shares that you owned, right? So the percentage of the shares a stockholder owns determines his or her share of the asset, which is distributed after the creditor and preferred stockholder. So what is the advantage or disadvantage of the corporation? So the advantage, of course, the first thing is limited liability. So if this firm go under, the only thing it's gonna damaging you at most is your invested capital. It's not gonna chasing after your house, right, or your car, your sofa. So that's the most biggest benefit is a limited liability. A stockholder can lose no more than the amount they are invested. And another thing is that stockholders in the form of a corporation, it has the ability to raise capital and transfer the ownership freely. So for example, you can raise any capital, any amount of capital that you want. And at the same time, if you do not want to hold a share of this company, it's very easily for you, I say very easy for you to sell to someone. And if it's attracting outside investment very easily because you're a public firm, you're offering outstanding shares. At the same time, you can sell the ownership to anybody very easily. And then disadvantage, first of all, and we kind of talked about that before going further. So it's additional taxes. The reason is corporate earnings are taxed twice. It taxed at the corporate level and also it taxed at the individual stockholder level. What that means that when there's a net income, right? We remember we always minus the tax before we get to the net income, but this is a corporate tax, right? Corp tax. And net income usually has to be flow into two resources. Either you have to clear dividend and the leftover go to return the earning, right? So to go to the dividend ones are the ones that flow to the individual stockholders. And these people's holding income from a dividend is also going to be taxed on their 1040, become individual capital gain, right? So that means taxed one here and one here. Okay. And then also besides the double tax, it's also have to endure a lot of paperwork because the regulation, right? If you're a public firm, you are overseen by SEC and federal and state government imposing a lot of reporting requirements for you to inform outside. So you have a lot of costs in terms of paperwork. Okay. So the key point I want you to take away from here is the primary advantage of corporation is because it has limited liability and the ability to raise capital. Okay, and the primary disadvantage is they needed to pay additional tax and more paperwork. So concept check: which of the following is a primary advantage of forming a corporate? A, reduce tax? No. Increase the personal liability? No. Limited liability? C, increase ability to raise capital and transfer ownership? That's right. Fewer state and fewer reporting requirement? No. Okay, so how do we record issuance of common stocks if you wanted to public offering your shares? So first of all, we wanted to tell you there's several different concepts about shares, a number of shares. First of all, authorized stocks, right? It's the ones in the incorporation article, right? So in the article, also authorized stock is the total number of shares available for sale. It should be already stated in your corporation article of incorporation. Okay, and this many stocks, not every stocks is actually issued. There is a portion of the stocks that you kept to yourself and not issue it, and the issued stocks is the number of shares that has been sold to the investors. And a company does not usually sell every share they authorized. And then in terms of issued shares, there's outstanding stocks, which is holded by outside investors, which is stockholders. And also companies can buy back issued stock and then treat it as a treasury stock, or in other words, company itself own these stocks. Okay, so authorized type of stocks. So type of common stocks we just talk about briefly. There's authorized stocks is the shares available for sale is equals to issued plus unissued stocks. And issued stocks is how many shares that you actually sold is equals outstanding share plus the treasury share. Outstanding share means the shares issued and held by the outside investor, and treasury stocks means that the shares issued and repurchased by the company. And then when we talk about the issued stock, we have to understanding what is the par value of the stocks. Par value is the legal capital per share of the stocks that is assigned when the corporation is first established. Par value original indicating the real value of company share of the stock. Today, par value actually has no relationship to the market value of the common stocks, right? So for example, Facebook's common stock, say, has traded as $100 since 2015, but the par value of the Facebook stock is actually 0.000006, right, per share. So therefore, par value has nothing to do with your market value of the stocks. Okay, and however, the law in many states permit a corporation to issue no par value stock. Okay, no par value stock is a common stock that has not been assigned a par value. Most new corporation and even established corporations such as Nike or P&G has issues no par value stocks. Okay, let's look at some common mistakes that you may confuse about. So you might confuse about the par value with market value. Par value is only a legal capital per share that is set when the corporation has its first established and actually is unrelated to value at all. And then the market value per share is equal to the current share price, right? And the most cases, the market value per share will be far exceed than the par value. Let's look at the example. Assume that Canadian Falcon issued 1,000 shares of no par common stock as $30 per share. So you will debit cash because when you issue shares, stockholders give you cash, and then at the same time they become your common stockholder, right? So there you will credit common stocks because there's no par value, hence that you will directly credit the common stock account. And assume that if Common Falcon is actually issue 1,000 share of one cent per share at the $30, then your journal entry gonna look like debit cash and credit common stock only using 1,000 shares multiple the par value as a $10 for the common stock. And we have another account called additional paid in capital. So this account, these two accounts actually composed by common stockholder equity. So in other words, in the common stocks, if you are actually issued with par value, with a legal capital value, then you will record your common stock using par value and additional paid, which is $30 minus 0.01 per share, multiple 1,000 shares, this will be called additional paid-in capital. Okay, so both common stock and additional paid-in capital are stockholders' equity accounts. Okay, key point here, if no par value stock is issued, the corporation debit cash and credit common stock. If a par value or stated value stock is issued, the corporation debit cash and credit two equity accounts. One is common stock at the par value or stated value per share, and additional paid-in capital for portion above the bar or stated value. So let's do an example. So a company A issued 20,000 shares for $5 par common stock at $12.50 per share. So the entry to record the issuance would include in which of the following? So first of all, the par value is $5, and then they sold at $12.50. So that means it's about the $7.50 is additional paid in capital per share, right? So therefore, if we multiply 20,000 share, that means it's going to be $150,000 additional paid in capital. Hence, we're going to credit additional paid in capital. This journal entry going to be debit cash, right? It's going to be 12.5 multiple 20 shares. It's going to be $25,000. And then you're crediting common stock, which is 5 multiple 20,000. It's going to be 100,000. And then you also credit paid in capital. So 150,000. So this is how you issue a stock. And both of these are equity account, stock equity account. Okay. Okay. So how do we understanding the unique feature and the recording of preferred stock? First of all, what is preferred stock? The feature of preferred stocks is that preferred, when we say it's preferred in two ways. Preferred stock usually have a first right to specify the amount of dividend, right? Have a preferred right to dividend. Meaning that if you declare any dividend, this group of people who holding preferred stocks gonna get it first before than common stockholders. And second is the preferred stockholder receive a preference over common stockholder in distribution of assets when the company is dissolved. Preferred distribution of assets. So this is make them special, okay? And about 20% of US companies actually have a preferred stock outstanding. However, unlike a common stocks, most preferred stocks does not have a voting rights. So this is another thing, no voting rights. That means that if you wanted to be first line when it's distributing the dividend, at the same time first line when there's a dissolution of the firm to distributing the assets, then you will have to give up your voting rights. Okay, so the feature of a preferred stocks is, first of all, it can convert. You can convert to common stocks if you want. Second, it's redeemable, means that the shares can be returned to the corporation at a fixed price. So if you don't want to be a shareholder anymore, preferred shareholder, you can get your money back. So you can sell back at a fixed price to the company. And third thing is it can accumulate a future dividend. In other words, once you declared the dividend and you didn't pay, right, to the preferred stockholders, those declared dividend can be treated as a liability. It can accumulating until that day that you really pay for the dividend. So in other words, shares receive priority for the future dividend if dividends are not paid in a given year. So more specifically, let's look at the common stock holders versus preferred stockholders and versus the bonds that we talk about in liability section. So I want you to compare this two with this two, and the preferred stockholders actually is between common stockholder and the bondholder. Okay, it's a kind of like a mixed combination as equity holder and creditor. First of all, the voting right for the common stockholders is yes, and bondholder, which is creditors, definitely no. Creditors does not participate in voting who can be a director. They are passive capital provider. And second, the risk to the investor. Of course, common stockholder have a very high risk because if they are the low, if they want to put the money into a company, they might likely to lose all of them. However, the bondholder actually is the lowest. The creditor is lowest because first of all, they are guaranteed for periodical interest payments. And then second of all, if the company have a high default risk or defaulted or bankruptcy, they are the first group of people to declare the residual of the assets to liquidate the asset of the company. And then expected return to the investor. Of course, the common holder will have the highest expectation to make to get return of the assets. At the same time, the bondholder is the lowest because they have a fixed interest rate return, right? And the preferred stockholder is between in the middle. Why is that? Because preferred stockholders usually they get a dividend, a cash dividend, and then what actually left over is majorly actually belonging to common stockholder. Preferred stockholder has almost a fixed rate of return, and then they are required to get paid periodically. Okay, but whatever left over is gonna give to common stockholders. Hence, that the potential of the return, the highest is a common stockholder, the lowest is bondholders. And the preference of dividend, of course, the common stockholder is gonna be the lowest in the rank, and then the bondholder, which is a creditor, is gonna be the highest because interest payment, if there's no negotiable, right? If a preferred stockholders, you can negotiate or you can declare and not pay them, but the interest payment cannot never be delayed, right? Because they are creditors. And the common stockholder is most flexible. If you don't declare dividend, they do not have a right to demand that dividend declaration for the specific period. And preference in the distribution of assets, same thing. In the time of the bankruptcy or dissolve of the company, the bondholder, which is creditors, are to have a highest priority to get paid. And the preferred stockholder that the company needed to, it's next to the rank of the creditor, because whatever left over after the liability that's paid, preferred stockholders need to claim those liability that has been accumulated as a preferred stock dividend. And the common stockholder is going to be the last one to get whatever left. And tax deductibility, okay, this is a very interesting thing. So as we mentioned, liability, debt contracting is actually cheapest way to funding the company. Hence, exactly, the tax deductibility is definitely 100% applied to the bondholder, which is debt holder. And the common stockholders is enjoy after tax, right? So the after the bottom line. So this is before bottom line. Hence that liability is the cheapest way of finding external funding resources. However, the equity holders is actually more expensive in terms from a tax perspective. Okay, so let's look at how do we issue a common preferred stock. Preferred stocks, for example, assume Canadian Falcon issued 1,000 shares per of a $30 par value, preferred stock at 40 per share. Exactly the same thing. You will debit the cash of 40,000 and you credit preferred stock for 1,000 multiple 30, and then you credit additional paid in capital, which is 40,000 minus 30,000 is going to be 10,000. And the presentation of the preferred stocks is look like this. So stockholder equity in the balance sheet, right? So this is zoomed in on the equity section of the balance sheet. And then preferred stocks, which is a $30 right at the par value, remember? And then you said 1,000 shares issued and outstanding. Common stock has a 1 cent of par value, 1 million share authorized. Not every, you don't need to issue all the authorized shares, right? And then they only issued 1,000 shares outstanding. And the par value is actually 1 cent. This is 1,000 multiple 0.01. And then the additional paid in capital here is including both additional paid in capital common stocks and preferred stocks. And then total paid in capital, you're gonna equals this one plus this one plus this one equals 70,000. Return earning is coming from net income, right? Net income and the return earning usually is net income minus dividend, right? It becomes return earning. And then adding this two up, you're getting the total stockholder equity. Okay, so how do we allocate the dividend between the preferred and common stockholders? If the preferred stocks is accumulative, okay, so that means the preferred dividend in areas for 2019 and 2020 is $4,800, and preferred dividend for 2021 is $1,000 multiple 8% in $30 per par value. So that's gonna be 2,400, and the remaining dividend to the common holders is gonna be 2,800. If the preferred dividend is non-cumulative, that means if you didn't pay last 2 years due to non-cumulative nature, you don't need to pay this year. Okay, so the scenario is that in 2021, the company decided to pay $10,000 of dividends. If the preferred stock is cumulative in nature, they needed to catch up whatever is not paid in 2019 and 2020 and pay the part of 2021, which is at 8% at the par value. So that means that about $7,200 is going to go to the preferred stockholders, and then whatever left over, which is only $2,800, go to the common stockholders. But if the preferred stock is non-cumulative in nature, since you didn't really pay the preferred stockholder last 2 years, and then it's non-cumulative, hence this year you do not need to pay them. You just needed to pay this year's preferred stock dividend, which is gonna be 2,500, 2,400, and whatever left is gonna be totally given to common stockholder. So in other words, because dividends are not an actual liability until they are declared by the board of directors, dividend in areas for cumulative preferred stockholders are not reported as a liability in the balance sheet. However, the information regarding any dividend in areas is disclosed in a footnote of the financial statements. In other words, in 2019 and 2020, although preferred stockholders accumulative, actually that you already owe them money, but you do not need to record them as a liability in the balance sheet. You still need to disclose it, but you don't need to put a liability. Okay, so the key point here we want to take away is that preferred stocks has a preference over common stocks in receiving dividend and in distributing the asset in event of corporation is dissolved. And we record issuance of preferred stock exactly same way as how we issue common stocks. Some preferred stocks is cumulative, meaning that any dividend not declared in a given year accumulated to be paid in the later years. So in other words, if you do not declare dividend, you know that those people who hold the preferred stocks need to be paid. But this expected dividend are not liability because you did not declare the dividends. But when you are ready to declare dividend, maybe 10 years later, who knows, whenever you are ready, you have to pay the old preferred stockholders dividend before common stockholders. So in other words, that if you owe them, you haven't declared dividend for 10 years, there's nothing you need the preferred stockholders can do because they are not debt holders. They cannot demand you to pay them. But whenever you are ready to pay, say the 11th year you're ready, then you got to catch up to pay all those old preferred dividends before you can distribute it to common stockholders. Okay, so let's see. Which of the following is a primary advantage of owning preferred stocks? A, preferential voting rights in most cases. No, preferred stockholders cannot vote. B, tax deductibility of the payment. No, that's the creditors, that's debt holders. C, preference over common stockholders in distribution of asset in event of dissolution. Yes. D, higher risk to investors than owning common stockholders. No, common stockholders are highest risks out of all the three people. Okay. Okay, so accounted for treasury stock. So treasury stock, we kind of talked a little bit about earlier. It's actually the company repurchase outstanding share. Means that the share you already issued was once held by the outsiders, and later on you purchased it back, and then you call those kind of shares the treasury share. So let's look at this graph, very interesting. From 1996 to 2016, the blue bar representing cash dividend declared by the company, and the yellow bar representing stock repurchase. As you can see, the blue is actually gradually increasing, but not as volatile as yellow bar. And another trend is that from early 90s to current 2020s, you can see majorly the distribution towards equity holders is actually take roles. Before, the cash dividend and the stock purchase is almost similar, right? Not one dominant the other. But in later years, as you can see, majorly company prefer to buy back their shares as a form of distributing to the stockholder rather than paying them dividend, right? So both of these form of activities giving money back to the shareholders. You can pay them cash dividend or you can buy back their shares. But the form of buyback is more significant or much higher since early 2000 to currently rather than pay cash dividend. Okay, so that's what I want to tell you about this graph. At the same time, as you can see, the buyback decision is very volatile, meaning changing a lot. Some years it can very little, some years can be very high, right? And the cash dividend seems are managing people's expectation. They are less volatile, they are more stable. Okay, so let's look more into the treasury stock. So there's a reason, several reasons why company like to buy back their stocks. First of all, it's trying to boost the underpriced stocks. Why is that? So when companies managing feel like the market of the stock price is too low, it's my attempt to support the price by decreasing supply of the stocks. So for example, if you find the demand is less than the supply of your stocks, hence that your stock price is really low right now, then you can stimulating the demand of your stock by buying back some, hence then the supply of the stock is decreasing, right? So buyback will cause supply of stock decreasing, hence the boosting the price. Second reason that you might like to buy back is because you want to distributing the surplus cash without paying dividends. And so while dividend usually are a good thing to do, the investors do pay personal income tax on them, right? Another way of firm to distributing cash to the equity holders is by buy back their stocks, because dividend, if you pay dividend, individual stockholders has to pay tax, right? That's not a very beneficial thing to do. But if you buy back the stock, then the tax is only portion that only to the difference between the buyback price and the original purchase price, right? So it's much less than the dividend. And then third reason that you might want to buy back your stock is to boost the earning per share. The reason is like earning per share equals earning dividing number of shares outstanding, right? So when you decreasing the outstanding shares, this ratio goes up, which is a very significant sign to the very important signature that you wanted to send out to the market that your company is doing well. Yeah. And then the last thing is to satisfy employee stock ownership plans. For example, if you're giving employee stocks as a compensation, then by buying back those granted stocks is actually a form of paying them cash, right? Okay. So the common mistake that some student might confuse is that purchase of the treasury stock with investment is another is with investment of another company. So you might think, oh, I buy back my stocks is equals I invest in my company. It doesn't work. It's totally different concept, right? So an equity investment is you purchasing stock for another firm, and then we always record it as an asset. But treasury stock is you purchase your own stocks, right? Hence, we record as a reduction of stockholder equity. It is not an asset. A company cannot invest in themselves. Okay. So let's look at an example. How do we record a purchase of a treasury stock? So first of all, Canadian Falcon repurchased 100 shares of its own 1 cent par value common stock at $30. So treasury stock, we want to debit treasury stock and credit in cash because you are giving the stock outstanding stock cash and you are creating treasury stocks. And then we do not record a treasury stock at the par value. Okay, we directly record how much is the purchase price. We debit the treasury stock. And the stock's par value has no effect in this entry to record a treasury stock. We record a treasury stock directly at its cost, which is a $30 per share in this example, to debit the treasury stock. And the debit of the treasury stock is trying to reduce the stockholder equity, because treasury stock is an control equity account. Okay, I will definitely test you this. What is the essence of the treasury stock? Asset, liability, or control equity account? So it's a control equity account. By debiting treasury stock, when you buy back, is actually decreasing equity. Okay, so let's look at the presentation. So stockholder equity before you buy back some stocks and after you buy back some stocks. So before you had the 100 share authorized and you have 1,000 share of preferred stock at $30 par, so 30,000, and you have 1,000 share of common stock at $1 a par, so your common stock is $10, and your additional paid-in capital is $39,990. Hence, your total paid-in capital, right, is going to be all this add up is going to be 70,000. Your return earnings, say you made $30,000 that year, okay, and your treasury stock 100 shares before there's a zero, and then your stockholder equity is 100,000. Look at when you buy back your share, nothing changes, but what happened? Your stockholder equity reduced for $3,000. Everything else same, except your stockholder equity changes. Okay. Okay. And then you minus 3,000 shares here, right? Treasury stock 100 shares at $30 share. Okay. Okay, so then you ask, what happened if I reissuance those treasury stocks above the costs? So let's give example. Canadian Falcon resells 100 shares of treasury stock for $35 more. Recall that this shares original was purchased at $30. So you would debit the cash for $3,500 and you're crediting the treasury share for $300 and you credit additional paid-in capital for that $500 because the extra 5 per share. So when we sell the treasury shares at 35, we must reduce the treasury stock account at the same $30 per share as the one when they are purchased back. We record a $500 difference as an additional paid-in capital. So before you hold the treasury share for $300, right, for $3,000, and then since now you are trying to sell it again, what happened is that we do not have a treasury stock, so this becomes zero. At the same time, we add extra money in here because that $50 is plus 50 equals this. Okay. Okay. So reissuance, what if reissuance the treasury stock below the cost, such as Falcon resell the 100 share of the treasury stock only at $25 rather than $30, right? So what happened? We still debiting cash and then crediting treasury stock of $30 because that's the one is the buyback price. And the difference we park in debit the additional paid-in capital, which is reducing paid-in capital. So in other words, when we resell the treasury stock at $25, we must reduce the treasury stock account at the same $30 per share when it's purchased. And then we record a $500 difference by decreasing the additional paid-in capital. So the conclusion here is that we're including treasury stock in the stockholder equity section of the balance sheet as a reduction of the stockholder equity because it's a control equity account. And when we resell the treasury stock, we report a difference between its cost and the cash received as an either increasing or decreasing additional paid-in capital. So let's look at the concept check. Treasury stock. A has normal credit balance? No, it's a contra equity account. Hence that it has a debit side balance. Right? B, decreasing stockholder equity. Absolutely. C, is recorded as investment. No. D, increase the stockholder equity. No. Okay, so before we move on into the part B, I just want to summarize that for paid-in capital, we talk about the common stockholders, how to issue common stocks, how to issue preferred stocks. If there is a dividend in arrear, what does that mean? Does it means a liability, or does that means that you have to distributing it whenever you're really ready to pay cash? And we did compare what is 20 years ago versus what is now. What's the difference between company to distributing cash back to their equity holders? It seems like they're more likely to distributing via buying back in the stocks. And then if a company buy back their stocks, their name of that kind of activity called a treasury stocks. And treasury stocks is actually a control equity account that reducing the equity section of the balance sheet. So, and then treasury stock can also sell back to the stock market. If you can sell at cost, or you can sell above the cost, or you can sell below the cost. So, and this, I don't think this chapter is it's very difficult chapter, and I believe that this chapter is more about learning new concepts. So I will see you in the next recording. We will talk about how do we handle earned capital. What is earned capital? Okay, thank you. See you next record.